What do you make of the payroll figure? I was encouraged, if I was looking at salaries in America, of the average earnings going up to 2.5%, but I was obviously dismayed at the lower pace of job creation.
Yeah, you're exactly right there. The headline number of 160,000 was obviously the weakest since last September. But if you look a little bit beneath the surface there's some indications of strength. And that's namely that wage growth growing at 2.5% continues at a pretty strong pace. And then even if you look at manufacturing wage growth, which is a sector that had been suffering for quite some time, picked up to about a 3% pace, which is the strongest in 2.5 years. So there's some pretty strong signs of strength. And then when you look at how the market views that, it's basically confusion.
Yeah, again.
Again.
Can I just come in on that point? Because when you look at the initial jobless claims figure, I think that was the lowest since 1973 that we had earlier in the week, plus the increases in wages, plus the fact that core inflation is picking up as well, and you mentioned the manufacturing. Did the market get the wrong end of the stick on the June rate hike?
To some extent. I mean, I think the key point here is that as we get back towards full employment, so we're at 5% already, we're not going back to zero. So as we get back towards 5%, the market's expectation for payroll growth needs to come down. So perhaps 160 is close to the new normal. And so then when you take that and look at what does that mean for the Fed as we look towards June, I think it's that back to that same confusion. What matters? What's on the Fed's dashboard right now? Is it payroll growth? Is it wage growth? Is it GDP? Is it the strong dollar? We simply don't know. It depends which Fed speaker you're listening to on which day of the week.
Sure.
And so that's why the market remains very skeptical. But what I would say is that if you look back at last December, at the first rate hike, up until the October payroll report at the beginning of November, the market really didn't believe that the Fed would hike. And then all of a sudden, in just a couple of weeks, we go from expecting no hike to fully expecting a hike. Sure. So we're back to data dependency, basically.
We had Barclays, Goldman Sachs and Bank of America Merrill Lynch immediately come out and say that means it's off the table now for June and July. Actually, they're predicting a September hike. But we had Dudley from the Fed actually saying, look, two rate hikes are still on the table. So I know you say we're back to data dependency, but we're still getting extremely mixed messages from the Fed at this point.
Yeah, and that's the rate hike cycle that we're in, because basically the economy is not overheating. There is no reason compelling them to move very quickly. And so that's why we keep on going back and forth between, is it the time to hike or not?
But what does this mean if we look at the reaction that we got in the equity markets? We got a bit of softness, then they rallied. Fine, we can argue on that point. Okay, it means that it potentially pushes back the likelihood of an immediate rate hike. But what about the dollar here? Because actually the dollar continued to rally. So I can't argue that for both of those things.
Right, and that comes exactly back to the Fed's dashboard. Is the dollar now no longer a concern for them? Because we're back to the bottom of the range. It's rallying a little bit.
Rallying again.
If it starts rallying again, it means that the market is starting to expect perhaps a rate hike in June once again.